fund was created about 14 years ago with the express idea of creating a fund for conservative investors that want a combination of high-quality, value-oriented stocks, investment-grade fixed income, and wanted a professional manager to be making the decision on what percentage of each of those to have in the fund at any point in time.
The markets remain ambivalent this week, so what's ahead for the next week? And beyond that, knowing that interest rates may keep us hostage for a while, with his ideas here, Roger Debard. He manages the Hotchkiss and Wiley Balance Fund, and also has $1.5 billion in separate equity accounts as well. It's nice to have you on the program.
Thanks, John.
It's nice to get an opinion from a balanced fund manager, because this market is very imbalanced. As you know, it seems to be this money flowing into core holdings. There's no hesitation to throw money into Yahoo, for example, on an upgrade like we see this morning. When you see that, it has to instill even more patience in you to sit tight in the stocks that you're holding right now as a balanced portfolio manager. Is this going to pay off for the rest of 1999?
Well, I think particularly the rest of 1999, looking at the new millennium, it very well. The idea is that we're focused on value, and value is defined in terms of being able to buy a combination of dividend yield and growth. We want companies that are leaders in their industry and that will effectively have good management.
Okay, we'll get to the companies in a second. Your level of stock holdings was up to 52% in the balance fund, and that's lowered down now to 46%. Do you think, in fact, this is going to be a relatively choppy market for the rest of the year, and you can see lowering that level even more?
Not necessarily, but if interest rates continue to go up, then that would be our incentive, because it's a balanced fund having a combination of stocks, value-oriented stocks, and fixed income. So if the yields were more compelling, then that would be the rationale for lowering our equity position, or if stock prices went up and the values were reduced.
It's not an easy market for you to play, because the bond market has not been any safe haven by any stretch of the imagination, especially the last 2 months. I know when we got to these very high levels in June in the stock market, many were flipping over to the bond market as a safe haven. It just didn't basically play out. It's not an easy play right now in the bond market as well.
No, but there are sectors of the bond market that are compelling. The long bond is off about 7% year to date. The corporate bonds are off about 3%. So in other words, there's a combination of corporate bonds, asset-backed mortgage securities that offer some safe haven and very compelling overall yields. Probably competitive to any equity returns over the next 12 months.
What are you holding in particular in terms of corporate bonds?
We're holding approximately 30% in a combination of mortgage securities, another 20% in asset-backed, and then a relatively low percentage in Treasury issues today.
We're going to have a slowdown, it looks like, in terms of corporate offerings. We had a big rush, as you know, over the last month. Is this going to help the bond market overall with less supply out there?
I don't anticipate that the spreads are going to come in, so I'm not sure that it's going to help it that much. I think the fact is that there's tremendous supply. Yields are also so compelling for many corporations that they're issuing debt today, particularly ahead of Y2K uncertainty, and I don't anticipate in the short term that that's going to change.
What do you tell an investor who says, I don't want to be bothered with a balanced fund right now? I could buy, a spider index of the, the NASDAQ and make, 30% for the year, or just go with an index fund tracking the Dow Industrials and you're up 20%. It seems like a no-brainer, and that's what the flow has been for the last 2 years, if not longer right now. What is the argument about going into a balanced fund?
Well, it's kind of the paradox of performance, that the past performance has squeezed out a lot of the value. The stock market, as measured by the S&P, is selling at about a 28-to-1 price-earnings ratio and a 1.3% yield. Not terribly competitive and compelling from a historical standpoint. So we would prefer to be in areas of the market, both in the kind of stocks that we buy and the value area of the market, as well as owning bonds, because these are the times that a combination of stocks and bonds will likely pay off, just in terms of controlling risk and producing the probability of a positive return.
I want to talk to you about strategy. I know there's some stocks you wanted to